embarked on an in-depth exploration of models incorporating endogenous money creation, starting with their crucial role in understanding the dynamics of financial systems. We began by examining how nonlinearities play a critical role in shaping financial accelerators and their broader implications. Specifically, we delved into two prominent financial accelerators, the Bernanke-Gertler-Gilchrist model, and a second mechanism centered around banks' efforts to maintain buffers above the minimum capital adequacy ratio.
The Bernanke-Gertler-Gilchrist financial accelerator traditionally involves linearizing a convex curve to simplify analysis. However, we solved the model under both linear and nonlinear conditions to highlight the stark differences. This exercise demonstrated that relying solely on linearization often results in a significant loss of valuable insights, especially concerning how financial systems behave during crises. Nonlinear models reveal critical details that linear approximations obscure, such as the intensity of financial instability and the depth of economic contractions.
Martin Harding and Raphael Auer's work on the global financial crisis shed light on the steepness of financial accelerators and helped set the stage for our analysis. However, we expanded on their findings by addressing how banks manage their capital buffers to avoid regulatory scrutiny. Approaching the minimum capital adequacy ratio triggers regulatory interventions, which can lead to distressed asset sales or forced changes in business models, outcomes that banks actively strive to avoid. Consequently, banks maintain precautionary buffers above the minimum requirement, navigating uncertainties in the financial environment.
With this foundational understanding, we shifted focus to the origins of financial crises, emphasizing the role of underpricing risk and overly optimistic expectations about fundamentals. Such conditions often precede crises, fueled by assumptions of perpetual good times. These scenarios align closely with Keynesian concepts like animal spirits, where economic actors' collective optimism or pessimism significantly influences macroeconomic outcomes. Recognizing these behavioral and psychological elements is essential to understanding the seeds of financial crisis. Building on this, we examined the role of counter-cyclical macroprudential policies designed to stabilize the financial system. These policies aim to adjust the minimum capital adequacy ratio dynamically in response to credit and asset price cycles. During periods of rapid credit expansion and soaring asset prices, these buffers are tightened to mitigate excessive risk-taking. Conversely, during crises or downturns, capital requirements are eased to stabilize credit availability and support economic recovery.
Simulations illustrated the profound impact of these policies. For instance, in periods of excessive credit expansion leading to asset price bubbles, tightening the capital adequacy ratio successfully curbed leverage and reduced the scale of subsequent corrections. When the economy transitioned to crisis conditions, the smaller credit and asset price bubbles moderated the adverse effects, resulting in less severe contractions in credit, real GDP, and financial spreads. These outcomes underscore the effectiveness of counter-cyclical policies in dampening financial volatility and mitigating systemic risks. We then explored how varying the minimum capital adequacy ratio influences long-term economic outcomes. Raising the ratio from 8% to 12% resulted in significant changes, such as reduced loan-to-value ratios, higher lending spreads, and lower real bank loans. This, in turn, lowered real GDP and the capital stock. Interestingly, as the economy becomes safer under higher capital requirements, banks reduce their precautionary buffers. For example, when the capital adequacy ratio is set at 8%, banks maintain a buffer of 3.4 percentage points. However, raising the ratio to 12% reduces this buffer to 3%, reflecting diminished uncertainty in the financial environment.
We also analyzed transition strategies for raising capital adequacy ratios. Imposing an immediate and unannounced increase from 8% to 10% creates a credit crunch, leading to sharp contractions in output and consumption. Gradually phasing in the increase or announcing it in advance allows financial markets and institutions to adjust, avoiding abrupt disruptions. Among these approaches, announcing the policy change 2 years in advance and implementing it gradually proved the most effective in minimizing economic costs while achieving the desired regulatory objectives. The importance of addressing non-linearities in financial models was further emphasized. Linearizing financial accelerators often results in underestimating the severity of crises. Non-linear models reveal the full extent of disruptions caused by excessive credit expansion and asset price bubbles, such as sharper contractions in equity prices, higher lending spreads, and more pronounced credit crunches. These differences highlight the critical need for non-linear modeling to capture the complex dynamics of financial systems accurately.
Despite the success of macroprudential policies in stabilizing financial systems, there is an ironic downside. They reduce the empirical variation necessary for identifying key economic parameters. Countries that successfully avoid financial crises through effective policies may lack the data to study such crises in depth. This underscores the importance of examining global experiences and learning from diverse case studies. Models like MapMod are invaluable for understanding credit risks and designing policies to mitigate financial vulnerabilities. Looking forward, our research aims to build on this foundation by transitioning from infinite horizon representative agent models to overlapping generations models that better reflect real-world complexities. These models will incorporate the critical role of housing, providing greater heterogeneity and enabling a more nuanced analysis of endogenous money creation. Additionally, distinguishing between good and bad credit expansions will require detailed micro-level data analysis and expert judgment.
Turning to contemporary challenges, we addressed the unfolding financial crisis in China, emphasizing the significant uncertainties surrounding its global implications. Limited data, transparency, and lack of clarity about China's economic mechanisms complicate efforts to predict the crisis's impact. Potential channels include falling commodity prices, as reduced Chinese demand for oil and metals could ripple through global markets, or broader systemic risks associated with rising equity and property prices worldwide. In the United States, household balance sheets have expanded dramatically, with financial and non-financial wealth growing by over $43 trillion since early 2020. This surge in asset prices, including a 116% increase in equity values and a 50% rise in property prices, has supported nominal GDP and consumption. However, it also raises concerns about systemic vulnerabilities. If asset prices decline significantly, the resulting economic instability could mirror the conditions preceding previous financial crises. Aggregate demand's resilience amid rising interest rates and tighter financial conditions highlights the role of elevated asset prices in sustaining consumption. Should this trend continue, the economy may face a twin crisis of excessive credit expansion and an asset price bubble collapse. Such a scenario would exacerbate financial vulnerabilities, particularly if GDP itself is artificially supported by inflated asset prices.
In conclusion, while the immediate risk of a financial crisis may seem distant, the underlying vulnerabilities demand vigilance. Over-reliance on nominal GDP as a measure of economic health can mask systemic risks, particularly when GDP is bolstered by unsustainable asset prices. Policymakers must remain proactive in addressing these challenges to safeguard long-term economic stability. On this cautionary note, we wrap up today's discussion, emphasizing the importance of continued research, robust modeling, and prudent policy design to navigate the evolving complexities of global financial systems.